Many tax strategies require you to act before December 31st of the tax year, not April 15th of the following year. So, if you are thinking about tax planning, time is running out. Today, I will explain to you the three most important factors to consider for the end of the year tax strategies. Hi, my name is Vid Panapali. I am the owner of Unique Financial Advisors. Let's get started. Number one, if you have capital gains in a taxable account in the given tax year, consider selling some of your unwanted positions, take the capital losses, and offset with the capital gains. For example, let us say at the beginning of the year you sold a position and you had a profit of $10,000. If you did nothing else during the year, no more transactions, then come tax time, you will have to pay capital gains tax on this $10,000 profit. Now, let us step back and look at it in a different way. Let's say you also hold a mutual fund position which has been underperforming and you lost about $15,000 on this mutual fund thus far. And you don't like the mutual fund anymore. Now that is an unwanted position. So here comes your opportunity. Get rid of the mutual fund. I sell the mutual fund at a $15,000 loss. Offset the $15,000 loss with the $10,000 gain you had earlier this year for a net loss of $5,000. By doing so, you are not only not paying a dime on your $10,000 profit, you could use $3,000 of this $5,000 net loss in the current year and carry forward $2,000 loss to offset with capital gains for in the following year. Number two, estimate end of the year capital gains accurately. You might be thinking, I haven't sold any positions during the tax year, so I have absolutely no capital gains tax for the year. Well, that may not be true if you held mutual funds in taxable accounts. Let me explain. In order to actively manage your money, mutual funds buy and sell underlying securities throughout the year. And in the process, if they make net profits, mutual funds are obligated to pass on the profits to you and then report the profits as capital gains at the end of the year, more precisely by January 31st of the following year. Now, if you do not know how much capital gains you have to pay for owning the mutual fund until January 31st, the question is, how do you or your tax advisor devise a tax strategy so you can minimize or reduce the tax burden of the capital gains? Here is how. Mutual funds, in the end of the year, generally speaking, provide you a per share estimate of the capital gains about this time of the year. And based on the number of shares you have and per share estimate mutual fund gives to you, you can arrive at a capital gains burden that you may have for the year. And then build a strategy based on that. Number three, review if a Roth conversion makes more sense to you this year. If it does, you must complete a Roth conversion before December 31st of this year. You cannot wait until April 15th of the following year. Here are a few things to consider if a Roth conversion is right for you. If your current year income is far less compared to the prior year's income, perhaps you are a candidate. If you believe tax rates are at their lowest and tax rates will only go up in future, then perhaps Roth conversion makes sense. Also, remember, the new tax law made the Roth conversion irreversible, meaning you have to, once you make a Roth conversion, it is final. There is no going back. Lastly, understand your tax rates and you pay taxes in the year of conversion. So find out whether you have enough cash flow to pay the taxes in the current year. Hope this information is useful. For more videos like this, please subscribe to my YouTube channel or follow me on social media. Thank you.